Stock Market Thoughts, October 6, 2023. Currently, the stock market is under pressure as yields are moving up. This chart shows that real yields are rising rapidly from negative levels. The yield is moving back to the period before the global financial crisis when there was no Fed quantitative easing. So, it's not surprising that real yields are moving toward 2.5%. It's worth noting that before the GFC, real yields ranged from 2% to 3%. If inflation expectations are at 2.5%, we should see the 10-year yield ranging from 4.5% to 5.5%. The shift is broad across regions and is mainly driven by a repricing higher of long-term real rates as markets fade recession risk and reassess fair levels of long-dated bond yields. More recently, negative inflation surprises in the US and Europe have helped keep front-end rates stable. On the growth side, U.S. consumer spending is still positive, growing at 5.8% year-on-year, although economic activity could slow down in Q4 due to the high rate, which will reduce economic activity. It's also widely reported that excess savings in households have been exhausted. Nevertheless, personal income remains positive, and a slowdown does not necessarily mean a recession. Regarding inflation, it's trending down, and the data so far support the idea that inflation will slowly move to the Fed's target. Arguably, the recent surge in the 10-year yield is mainly driven by better growth expectations and the expectation of the Fed keeping rates high for longer. Historically, when the 10-year yield increases more than 1% over a short period, it has almost always been followed by a retracement of a third of the increase. We might see this happen again after the recent surge in yield, especially if Q4 growth slows down. In the derivative market, a larger position is being built up to short the 10-year Treasury futures. Short positions in U.S. Treasuries have reached all-time highs and could lead to strong price reactions in case of short covering, which would push the 10-year yield lower in the near future. In the stock market, with real yields moving up, valuations have been declining. Year-to-date, mega-cap tech has outperformed the remainder of the S&P 500 by 51%. The year-to-date return for the other 493 stocks is almost flat. This year, only 20% of large-cap funds are beating their benchmark, as underweights in mega-cap tech continue to weigh on performance. The recent drawdown of mega-tech stocks may offer an opportunity for those fund managers to increase exposure to mega-tech stocks. With the recent stock market correction, mega-stock valuations have dropped from 34 to 27, while the valuations of the rest of the S&P 500 stocks have dropped from 18 to 16. Megatech stocks valuations, based on the P/E ratio, still look higher. However, if adjusted for growth, the relative P/E ratio adjusted by the growth rate makes megatech valuations look cheaper. Overall, the stock market valuation looks reasonable excluding the megatech stocks, but the megatech stocks have strong balance sheet and less sensitive to the interest rate movements. The consensus expects the largest tech stocks to outpace the remainder of the S&P 500 in terms of sales growth in the coming years. In the next 2 years, megatech stocks are expected to deliver 12% growth, while the rest of the stocks will only grow by 3%. Although consensus estimates have set the bar high, the largest tech stocks, in aggregate, have beaten pre-season consensus sales growth estimates in 81% of quarters since 2016, typically growing sales 2 percentage points faster than pre-season expectations. This compares with 68% of S&P 500 companies having beaten consensus sales estimates in the typical quarter since 2016. The S&P index is now very close to its 200-day moving average, which is a critical level that many traders are watching. Investor sentiment has now turned bearish, and the put-call ratio also shows that investors and traders are in fear mode, buying more protection. This might trigger some rebound in the near term for the stock market.